Real estate is one of the best places to invest your money because when you invest in real estate, you own something tangible that you can see, feel, and touch. You get passive income through cash flow and you get tax breaks. And in this video, I'm going to be going over the 10 things you need to know when it comes to buying your first rental property. What's up, everybody? I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. Real estate is my favorite place to invest my money because when I invest in real estate, I can predict how much money this property is going to make me every single month after I buy this property. And so when I'm buying real estate, my goal is just to build up a number of properties that way each property is paying me every single month. If you can make $500 a month in profit from one property, which is doable, then if you have 10 properties, that's $5,000 a month coming into your pocket in profit that you don't have to work to earn. That's $5,000 extra every single month that you can use to spend on whatever you want. I've been investing in real estate for about a decade now, and I've seen real estate from a few different lenses because I'm a real estate investor, I'm an attorney, and I used to be a real estate salesperson. And in this video, I'm going to be going over the 10 things you need to understand when it comes to buying your first rental property. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. The 10 things that you need to understand when it comes to buying your first or your 10th or your 100th rental property is first, the location, because you probably heard when it comes to real estate, location, location, location. You cannot move where your property is, so your location matters. Second is understanding the cash flow, the finances. How do you understand if a property is profitable or not? What numbers do you got to look at? Third comes to actually negotiating the contract. How do you find a good price? How do you make it work? How do you negotiate that? 4 is inspections. What kind of inspections do you need? How do you make sure a property is good and that it's not going to screw you over after you buy it? 5th is financing. How do you actually get the cash to buy the property? 6th is the legal side, because the last thing you want is for your tenant to sue you because they slipped and fell in your bathtub because it was too slippery when it was wet. True story. 7 is renovating the property. How do you renovate it and how do you get the best return on your money? 8 is actually finding a tenant and renting it out. 9th is making the property passive. That way you don't have to physically work to get this cash flow. And number 10 is if you are ready to sell the property, how do you sell the property and not pay any taxes legally? Let's get into number 1, starting with the location. When you're looking for a property, before you go out and you actually make an offer and buy a rental property, the first thing you want to do is look at a bunch of different properties. You got to look at least 10 properties before you make an offer on one, because if you're just starting off, you're not going to know what a good location is or what a good property is or what a bad one is. And so you want to just start walking through homes and start walking through neighborhoods. One of the easiest things that you can do to determine if a property is in a good location or a bad location is just walk the neighborhood, walk through the streets. Is there something nice? Are the homes boarded up? Are they burned down? Or is it nice? Are your neighbors taking care of the landscaping? Is there money coming into the area, or is the money in businesses moving out? There are 3 big things that you want to look at when it comes to finding a good neighborhood or a good city to invest your money in. Crime, the flow of money, and the city laws. There are a bunch of tools on the internet that you can look at to see what the crime is in the neighborhood that you're looking to buy in. If you see that the crime is increasing, that's not a good sign, because when you buy a property, this is something you're owning for the long term, right? When you're investing in real estate, this isn't a 6-month play or a 1-year play. You're investing in real estate for a long time because you're going to own this property and you want this to pay you rent for years into the future. And if you're buying a property in an area on the verge of a downturn, then your investment is going to be more of a headache than it is a cash cow. When you're looking at the flow of money, what you want to pay attention to is, are businesses coming into this area, this neighborhood, and the city where you're investing, or is money flowing out? The easiest way you can determine this is just by going to your city hall and asking them what new developments are coming in and what new building plans do they have for that area. If they don't have much, or if you see that this building development is going kind of somewhere away from where your property is, that's not a good sign. This one is huge. I was in contract to buy a home and I went to the city and they told me that there was this vacant plot of land that was nearby the home that I was buying, and Walmart was coming in and they had plans to develop a Walmart supercenter. That was good news for me because that told me that money was flowing here. If Walmart was willing to open up a store less than a mile from my property, that means there's going to be more jobs coming. That means there's going to be more retail stores coming, because anytime you see a Walmart supercenter pop up, that means you're going to have more stores pop up in front of it and on the side of it, because Walmart drives a lot of traffic. So if there's a lot of money coming in that area, that means property values are probably going to go up. Rental values are probably going to go up because there's going to be more demand for that area because there's more jobs and more businesses coming. So is is the money flowing to the area or out? Because if the money's flowing in, then you can buy this property today and you can expect rent prices to hopefully continue to go up because now there's more money and jobs coming into that area. And then you want to take a look at the individual city laws itself, because what you're going to see happen is some cities are more tenant friendly and some cities are more landlord friendly. A tenant friendly city is going to make it very hard for you as a real estate investor or a landlord to kick out a tenant that's not taking care of a property or that's not paying you rent. And so you want to pay attention to that, because if you are investing your money, you want to be in a city that is more landlord friendly, ideally, because if somebody is not paying you rent, you want to have the ability to kick them out without facing a whole bunch of roadblocks and a bunch of hurdles. Another thing you want to pay attention to when it comes to city laws is how strict is the city when it comes to city inspections. Now, there are certain cities that I just avoid buying in because they have these super strict standards and they will fine you up the you know what if you have grass that grows 2 inches, or they're going to charge you a $200 permit fee if you got to change the batteries in your smoke detectors. I've already dealt with the headache and I don't want to deal with that anymore. So when I invest in properties, I'm looking at what the city laws are, and the best way you can figure this out is just by talking to real estate investors or real estate agents in your area that are familiar with investment properties. And so if you're looking at properties, talk to a real estate agent because they can help you find some. And if they're actually familiar with real estate investing, they should understand how these city laws work so they can guide you and help you find areas where you won't have to deal with all the headaches. When you're investing in real estate, you have to be thinking for the next 10 years because you cannot move the property's location. I mean, if a home is beautiful, that's nice, but if it's in a really bad location, the niceness of the home doesn't make up for the bad location. One of my real estate teachers used to tell me, find the worst home in the best neighborhood, because the neighborhood is going to help drive up the home value and the demand for the property. If it's a good home in a bad area, it doesn't matter. You're going to have a really hard time making a profit on it. But if you have a bad home in a good area, now you can be sitting on a gold mine because you can renovate the property and you'll still have demand for people wanting to live in this home because it's in a good location. Sometimes that means you'd be better off paying a little bit more for a home on one side of a street than another side of a street. Like I was looking at buying a home in a city where they had a highway cutting right through the middle of the city. But on one side of the city, these homes were about 20% more than on this side of the city. But what I saw by talking to the city hall was that there was a lot of new developments coming on this side of the highway, and there was a lot of businesses moving out of this side of the highway. So it's the same city, and we're talking about just on one side of the road. But I decided to buy here, even though this cost me 20% more, because I saw that there was money flowing in this area. Over the next 5 years, rental prices here went from about $850 a month to $1,200 to $1,300 a month, while rental prices here dropped just because everybody wanted to be on this side of the road, not this side of the road. So you got to understand why your location is so important, because it's going to play a factor into how much money you make over the long term. Once you narrow down what cities and neighborhoods you want to invest in and you start looking at properties, that's when you got to understand, when do the numbers make sense? How do you analyze the finances of a property? I'm going to get to actually how you get the cash a little bit later in this video, but let's talk about understanding the numbers first. I like to be conservative when I do my financials because I have no problem if I run my numbers and then I make more money than I thought I was going to make, but I'll be a little bit more disappointed if I make less money than I thought I was going to make. So I like to do my numbers accordingly. So the way I look at it is, first I take my rental income, whatever money I think I'm going to make, and if you're working with a real estate agent, they can help you figure out what your projected rent will be. And then you want to subtract your property taxes, your insurance, your maintenance, because you're going to have maintenance if you own a property, then your management costs because you want this to be passive, and then your vacancy because your property is probably not going to be leased out every single month. You subtract these from this, and then you're going to have your net income. So let's run through an example. If you wanted to buy this property that was $150,000, what would the numbers look like? So if I bought this property for $150,000, I should be able to rent it out for something like $1,400. Maybe a little bit less, maybe a little bit more depending on where you live, but let's assume $1,400. So taxes, property taxes, I like to estimate around 2% of the property price. So if we're looking at $150,000, that's $3,000 of property taxes a year, and that is right around $250 a month for property taxes. Then insurance, or a $150,000 property, something around $100 a month in your property insurance, landlord insurance. Then for maintenance, I like to be conservative and I like to estimate 10% of my gross rental income. Hopefully my maintenance is going to be way less than that, especially if I buy a property and I renovate it. After I get the property renovated, hopefully my maintenance is going to be close to nothing, but I want to be conservative. So if I do 10% of that, that's $140 a month in maintenance. Management fees, I like to estimate 10% for management fees. Now, I pay way less than that because I have a number of properties, and so I worked out a deal with my management company. I'm paying close to 5% in management fees. But if you're just starting off, you might be paying that 7 to 10% range. So if you want to be conservative, that's another $140 in management fees. And then vacancy, I like to estimate 1 month of rent a year in vacancy because your property might not be tenanted all 12 months of the year. Somebody might move out, and so you're going to have a period of time where you're going to be leasing the property out and not making any money. So if I'm not making 1 month of rent out of the year, that means that's another $116 or so that I'm not getting. So if I add these all up, I got my calculator right here, that leaves me with a net income of $654. Let me get my black marker. So $654 a month is what I'm making off of this property. Now, this is assuming you bought this property with cash. I'm gonna go over what happens if you bought this property with a loan in just a second, but you're making $654 a month with just $7,848 a year, and you paid $150,000 cash to buy this home, which means you are getting right around a 5% cash on cash return a year. Now, personally, this is a little bit lower than what I'm looking for, but this gives you an idea of how to run the numbers. When I look at a property, I'm looking for a minimum 7% return on my money, assuming I buy the property cash. Ideally 8%, but a minimum 7%. So maybe I'll have to get a better rent. Maybe I'll have to pay less money in management fees, which I'm already doing. Maybe I'll have to see if I can get a better deal on my insurance. Essentially, I gotta have more money every single month in order to make this deal worthwhile. But what happens if you bought this property with a loan? If you use debt, then you might be putting down 20% of the home value, $150,000. So you have to put down $30,000 cash, and then the bank is going to give you $120,000. So now you have the $654 a month that you have in profit, but you also got to pay your bank. And if you are borrowing $120,000, you might be paying your bank something like $560 a month, which leaves you with just under $100 a month every single month in profit. I think it's about $94 a month in profit, and this will bring your total return down on your $30,000 cash investment to right around 4%. So not the best return, but again, we're being pretty conservative here. You should be able to get a little bit better rent here. You shouldn't be paying this much in maintenance. So you can probably bump these numbers up in reality a couple percent, but I'm just trying to show you how the numbers work. So anytime you walk through a deal, these are the numbers you want to be looking at, and you want to make sure you do this analysis for yourself, because sometimes you're going to see sellers agents create their own pro formas to show you that you're getting this amazing return on this property that you're looking at, but they might not include vacancy, they might not include management, and they might really lowball this maintenance cost. And so all they're really showing you is your rent minus your property taxes minus your insurance, and they're ignoring this half. And so you want to make sure you're doing this pro forma yourself, that way you can get kind of a real idea of what the numbers will look like in your bank account, not just what they look like on an Excel sheet. The last thing I want to mention about the finances is this return that I'm showing you is just the return you're getting every single year on the cash that you have to invest today. This did not include property appreciation, home prices going up or real estate prices going up. That's just the icing on the cake. When you buy real estate, you want to make sure that this number makes sense for you. If this number makes sense for you and then real estate prices go up, that's even better. If real estate prices come down, oh well, at least you're still making your rental profits here. But the reason why your location matters so much is because now what you're going to see happen over the years is this top line rental number is going to go up, while at the same time your expenses aren't going to change too much. Yeah, they'll go up a little bit, but they're not going to go up as fast as the rent as long as you're in a good location. So what you're going to see happen over the years is the return that you're getting on your cash is going to increase every single year that you own the property, because you're going to see rental prices go up with expenses not growing as fast, which is why you want to own a property in a good location. And then when it comes time to sell, the advantage here is, let's say the property value doubles to $300,000. In this instance, you put down $150,000 and you doubled your money, because now you're getting $300,000 when it comes time to sell. Here, you only put in $30,000, and then you're gonna make another $150,000 in profit on the sale price, because you only put down $30,000 and then you make another $150,000 on the appreciation of the property. Now, when you find a property like where the numbers make sense, now it's time for you to negotiate the contract, because you wanna make sure you get the best deal possible. And the type of negotiating and the leverage that you're gonna have is gonna depend on what type of market that you're in. If you're in a seller's market where property values keep going up and everybody's trying to buy a property, then you're not going to have as much negotiating room as you would as if you were in a buyer's market when everybody's trying to sell their home and home prices are going down. During these markets, you can be super aggressive with your offers and still probably buy the home just because that's the market that you're in. Things that I do to find the best deals is, one, when I look at properties, I'm not looking at the super nice homes. I'm looking at kind of those medium range homes, not the super bad homes and not the super great ones, right in the middle range, because I found those to give me the best returns. And second, when I try to find properties, I like to find properties that are beat up, either beat up physically or beat up financially. In the real estate world, they're called distressed properties. I like to call them value add opportunities. Essentially, I like to find a property, if it's physically beat up, that is cosmetically challenged. So it might have really bad floors, the paint might be ugly, the kitchen might be outdated, the landscaping might be horrible. When a regular person walks through this home, they're gonna be like, oh my God, this looks ugly and it smells, I don't wanna look at this, and so they're gonna walk out. For me, that's a great opportunity because now I'm not really competing against anybody to buy this home, so I can buy this property way below market value and I can renovate the property and make it look brand new and then own this property at a huge discount below fair market value. If you're looking at commercial properties or multifamily apartment complexes, you can also find a financially distressed property, which means you might have a 20-unit apartment complex and this apartment owner, this real estate investor, doesn't know how to manage the property, and this 20-unit apartment complex has nobody paying their rent and it has a lot of vacancies, and so this is financially distressed because this apartment owner, this real estate investor, is losing a lot of money, and so they just want to get the property off of their books, so they're willing to sell it at whatever price because they just want to get rid of it. If you are an experienced investor and you have the right team, then you can come in and buy this property and turn it around and make a much bigger profit because now you're buying this property for way below market value. The key for any of this to work is you got to put your emotions on the side and you got to focus on the numbers. So many people get caught up on the emotions because they want to invest in a cute home. But when you invest in a cute home, you're going to have cute profits. If you really want to make the money, you got to invest on the numbers, right? So if you're looking at a property and it's ugly, it might not look nice, but you can turn this property around and make a lot of money on it if you look at the numbers. When I was first looking at properties back during the 2008 crash, I took my mom with me a few times, and these properties were ugly. I mean, they were beaten up, they had mold and mildew inside, but they were selling for dirt cheap. And I remember my mom telling me, oh my God, I don't want to be in here because these homes are so nasty. I mean, there was holes in the walls, there were sometimes animals living inside. So a lot of these homes are super beaten up because this was in Michigan, which was really hit hard by the 2008 crash. And a lot of these homes were selling for $5,000, $6,000, $7,000. And now today, these homes are worth almost $100,000, rented out for $1,000 a month. But I didn't buy some of these just because I got emotional and I didn't realize that I could have turned these kind of like crap properties into gold mines if I just understood to let my emotions be on the side and understand the numbers. This is where you got to understand that real estate investing is not for everyone. I mean, you got to get down and dirty and you got to work with a bunch of people. You got to find the real estate attorneys, the real estate agents, the real estate contractors, and the property managers. And so you got to find these people, work with them, and really understand how the process works. If you're not interested in that, then it's going to be hard to really be a successful real estate investor. I mean, yeah, you could just throw in money and find somebody to go find you the deals and do all that, but you're going to get a lower return because you're not willing to go out and actually find the deals and maybe renovate them. You don't have to do single family homes. You can do much larger apartment complex and you can do more commercial properties, but if you're not willing to go out there and put in the work, you're going to have to pay the price for that in lower returns. Now, there are alternatives with things like real estate crowdfunding, where now you can just invest your money and get exposure to a real estate fund. That way you don't have to deal with tenants or property managers or any of that. So if you want to learn more about that, our team put together an article that breaks down how you can invest in real estate without actually buying physical real estate. If you want to read the article, it's on our website, theminoritymindset.com, and I'll link it for you in the description below. But when it comes time to negotiating the contract, one thing that no matter what you are doing when it comes to price, one thing that you have to incorporate is a property inspection contingency, which says that you have the ability after you enter into a contract to go through the property with your own private inspector or your city inspector, and then you can decide if you want to continue buying this property or not. It is so important, and let's talk about it in number 4. Not doing your proper due diligence and getting the right property inspections is one of the easiest ways to make a deal go bust. I'm telling you this from experience. There was one deal that I did. It wasn't even a big deal. It was a small home that I bought because a contractor that I was working with told me that this would be a great investment. I purchased the property based off of his word without doing any of my own private property inspections, And that single deal came around to bite me in the butt, and it was one of the biggest headaches I had ever had to deal with in real estate. I made a video where I talked about this in my worst real estate deal ever. If you want to watch the video on YouTube, I'll link it for you in the description below. But essentially, if you have a property inspection, you can take a private contractor, a private inspector, and this person's job is literally to just walk through the entire property and make sure your property is not on the verge of falling apart. So they're going to walk through and see the foundation of the property. They're going to see how the roof is. They're going to see the mechanical, the electrical, your plumbing. So they're going to go through the entire property and make sure the systems in the property are working, because the last thing you want to do is buy a property and then find out you need $100,000 worth of renovations when you only budgeted $6,000 worth. Getting a private property inspection is going to cost you a few $100s. And this is money you have to pay before you actually buy the home, because as soon as you enter the contract, you want to have the contingency period, this due diligence period, where you can inspect the property with your inspector. And so you're going to pay this inspector a few $100s, and they're going to go through the property and they're going to give you a report which tells you everything that's wrong with the property physically. And once you get that report, you can decide if you want to continue buying this property, or if there's a lot of repairs and renovations that need to be done. You can tell the seller, hey, I need a discount on the price, because right now they're kind of like on the hook, because if you don't buy it, then the seller has to start the selling process all over again. And so you kind of have to make this decision as to if you want to negotiate how much, or do you want to just walk away from the deal, or do you want to accept the deal as is? In addition to getting your own private property inspection, you also want to consider having the city come out and have them do a city inspection, because most cities require you to register your property as a rental. So you're going to have to work with the city hall and tell them that you want to rent this property out. And they typically are going to come out and do their own inspection and make sure that this property is livable and there's not any major issues. If you do a private property inspection, you should find all the major issues, but the city might tell you something that you didn't expect, or they might make you do things that you didn't know you had to do. So you want to talk to the city early on, and you want to know exactly what your costs are going to be before you actually buy the property. That way you can do your financials and your numbers based on what your actual costs are going to be. So before I buy a rental property during this due diligence period, I do three things. First, I get my own private inspector to go out and walk through the property and tell me what's wrong with it. Then I like to have the city come out. That way the city can tell me what I need to do to get this property licensed for rental. And third, I'm going to have my contractor go through the property. That way I can show him a private property inspection, the city inspection report, and then whatever renovations I want to get done. That way I can see what my total costs will be to get the property renovated and ready to go before I actually buy the property, so I can look at the numbers. Now, one little caveat I want to give you is anytime you get renovations done, chances are it's going to cost you a little bit more than what you expected. So just kind of budget that in there and understand that, because almost always you're going to pay more than what you thought to do the renovations. Once you find a property that passes your due diligence, now you got to get the cash to actually buy the property. This isn't something that you want to start after you enter into contract to buy the property. If you're talking about getting financing or getting cash, you got to know how you're going to get the cash to buy the home before you even start looking for homes. But now is when you got to get serious and actually get the cash to buy the property. And when it comes to getting the cash, there are three ways that you can purchase real estate. You can buy a property all cash if you have enough money in your bank account. You can use equity partners. So if you want to buy a $150,000 property, you and two other people might front $50,000 each, and now you three are equal partners in this property, and you're going to share in the profits, in the rental profits, and when it comes time for you to sell the property, assuming that you make any money. And then you can use debt, where you can borrow money and pay this money back plus interest. And the way you can get this debt is through a bank, or you can do a land contract, which is when the seller of a property gives you the cash to buy their home. If you're like most people and you don't have all the cash in your bank account to buy a property, then you're going to have to do one of these two. And these are two things that you want to start preparing for before you actually start looking at properties, because you want to make sure you have the cash ready when it comes time to actually close. Like if you're going to go get debt and you want to borrow this money from a bank, your bank is going to want to see income statements for at least the past 2 years so they can see that you have stable income. They're going to want to look at your credit score. If you want to get the best rates, you want to have a minimum of a 760 credit score, and they're going to want to see your experience and your reputation. So the bank wants to see that you are a safe investment for the bank's money. A land contract, on the other hand, is when you want to buy this property right here and you tell the seller, okay, I want to buy this $150,000 property, but I can't qualify for a loan. Either I don't have a good credit score, or I don't have enough income to show the bank, or whatever. I can't qualify for a loan from the bank. And so I will give you, the seller, $10,000 today, and in exchange, you hold back a note, a loan, for the remaining $140,000. So the seller will only get $10,000 today. That's what you give them. And then every month after that, you're going to pay the seller interest on this $140,000. And so the term typically on a land contract is usually 5 to 10 years. It's not usually a 30-year term like you see with banks, because these sellers want to get their money. And the interest rate you're going to pay on a land contract is typically higher than what you're going to pay if you got a loan from the bank, because the seller understands that if you could get this money from a bank, then you wouldn't be asking the seller for a land contract. So a land contract is an easier way for you to get money, but you got to pay an extra fee for it. And one thing that people like to do is maybe you can go buy this home, use a land contract to get it, and then once you're ready, you can go to the bank, refinance this home. That way the seller can go out of the picture, you pay off the seller, and now you're paying this lower interest rate to the bank. But the thing you got to be aware of here with refinancing is if property values go down, then it becomes harder for you to refinance. So you just got to understand the risk. And the thing about debt that you have to understand is the more debt that you take on, the more risk that you take on. So I want to make sure you understand that when you're buying this property, you're buying cash flow, you're not just buying a headache. And so you don't want to take on too much debt. This is one of the things that people get really excited about in real estate. Is there's this whole industry of people promoting the no money down real estate, where you might do something like buy this $150,000 property where the bank is going to give you 80%. They'll give you $120,000 and they'll say get the other $30,000 from the seller through a land contract. So the seller gives you $30,000 because they don't need all that money today. You pay it off over time, and then the bank gives you the other $120,000. So you bought this property with no money down, and now hopefully you can make a profit. And if property values goes up, that's all your money. Now, while this sounds great in theory, it also comes with the most risk, because if your tenant stops paying or if your tenant damages the property, you have no skin in the game. And if you don't have money to take care of that and to cover your costs, now you're going to be the first one to go underwater and get the property taken away from you by foreclosing on the property, because the bank or the seller is going to ask for the property back. So debt is a tool, and it can be a good thing, but too much of a good thing can be a bad thing. So if you take on too much debt and the economy slows down, you're going to be the first one to lose everything. Now, if you come to equity, this is where now you're going to have partners in the deal. There's a couple ways that you can do this. In some instances, you're going to see that you have doctors or attorneys, these high-income people who might have a lot of money but don't have the time to go and invest in the property. You can go to these people and say, hey, give me 15% equity in a deal and we'll work on deals together. So you go out, you find the properties and you manage them and you make sure that they're profitable. And this cash provider, this rich person, is getting 85% of all the profits. You get 15%. So you're managing the deal. You don't have to put in any of your own cash, but you get 15% equity. Or the alternative is you find a couple partners, you want to buy this $150,000 home, you all put in $50,000 each, you're equal partners in this instance, and so every time you make profit with your rent, you guys split the profit, 1/3, 1/3, 1/3, and when it comes time for you to sell the property, you share the profits, 1/3, 1/3, 1/3. You can compare that to debt, where in this instance, let's say this property sells for $1 million, okay? In this instance, the bank and the land contract owner are only gonna get whatever money they were in contract to get. So they're only gonna get this $150,000 plus interest. They don't get any of the profit. Here with the equity holders, you only get 1/3 of the profits because you only own 1/3 of the property. When you buy a property with cash, then it's simple. You're just using your cash to buy the property. If you are a cash buyer, here's a little hack that I've used in the past that you might like. So if you want to buy this $150,000 home, what you can do is you can go to the closing table and you can buy the property for $150,000. But one thing that you can do is, let's say you're buying this property through an entity. I'm going to talk about this in just a minute. Now, instead of you depositing $150,000 into this entity and then buying this home, what you can do is, instead of you depositing it into this account, you can loan this money to your account. So now this entity that you own, I'm gonna talk about this legal entity in just a second, but you own this entity that owes a loan to you. So now when you buy this property, you still have to make loan payments, and this loan payment goes back to you. So now your real estate investment has more of an expense because you have to pay interest, but all that money is going to you. So you get a bigger deduction and the interest tax break. Now, although I am an attorney, I'm not your attorney. So if you have specific tax questions or legal questions, talk to a professional in your area. This brings me to number 6, understanding the legal side of real estate, which means you got to understand what an entity is, a real estate entity, understand real estate insurance, and having a real estate attorney on your side. So when I buy real estate, I never buy real estate under my own name. Like, I don't actually own any real estate. I own real estate companies which own real estate. So the way it works is like this. This is me, and you know, I'm gonna draw me a nice mustache. I own this entity right here. Let's call it JS Real Estate. So I own JS Real Estate. This JS Real Estate might own this home right here. I don't actually own the home directly, because if I own the home directly and something bad were to happen, let's say a tenant lived in here and they slipped and fell in the bathtub because they said the bathtub got too slippery when the water was on, true story, and then they sued me. If I own the property, then they'd be able to come after me and my personal assets. But if this property is owned by JS Real Estate, then the most they can get, assuming that insurance doesn't cover this lawsuit, the most they can get is whatever this entity owns. And so this entity that I have, in this case, it might be an LLC. You got to ask an attorney in your area for what's best. But in most instances, LLCs are the best way to go. This entity is kind of like a barrier or protection that protects you and your personal assets from lawsuits and anything bad going on with your property. There's a saying in the real estate world that if you are a real estate investor and you haven't been sued yet, then you haven't been in business long enough. I mean, this is just the reality of being a real estate investor, especially in the United States, because you can be sued for anything. Like I had a tenant sue my real estate company because they claimed that the bathtub was too slippery when the water was on. I already made a video on YouTube where I talked about that, so if you want to watch that and learn more about what happened, I'll link that for you in the description below. But this is where you got to understand, okay, what can I do to protect myself? That way I can protect my personal assets. And the way you can do that first is by creating this legal entity. The second thing you want to do is have real estate insurance. This real estate insurance is there kind of as the first shield before the entity, because this real estate insurance is there to protect you from anything bad happening. Like if a tenant slips and falls, or if the tenant sues you, first thing they're going to do is go after your insurance. So this insurance is there to protect you from lawsuits, and it's also there to protect your property, because if this property gets burned down or something bad happens to the property, that's where insurance is there to protect your assets. So insurance is your first line of defense. If the insurance fails, or if they don't cover you for whatever reason, this is where your entity is your second line of defense to protect you and your personal assets. The third thing that you want to make sure you have on your side throughout the entire real estate process is a real estate attorney. From the minute you start negotiating deals in real estate, you want to make sure you have a good real estate attorney on your side, because they're going to help you review your purchase agreements. They're going to help you review your due diligence. They can help you negotiate the contract with your contractors, and they can help you deal with city inspectors. You need to have a good real estate attorney on your side. I know they can be expensive, but it's a small price to pay today that can save you a huge headache in the long run. You want to make sure you have a good attorney that specializes in real estate. You don't want to just get a general attorney. I'm telling you this from experience because I am an attorney. There's a lot of kind of complexities and little things involved in real estate. So you want to make sure you have an attorney who's very familiar with real estate, not just a general attorney, because they can protect you from huge headaches in the future. Now, moving on to number 7. Once you get this property, now you want to start renovating it and get it rent ready. But you want to make sure when you're renovating it, you're getting a good return on your money, because you just don't want to throw all your money into these fancy renovations that they're not going to pay you any more money. So the first thing you got to understand is what sells a home, or what gets a home leased out. That's kitchens and bathrooms. If you do decide to make upgrades in a rental property, those are the two places that get a lot of attention, kitchens and bathrooms. So if you do decide to make renovations, look at doing things there. The next thing you got to look at is the durability of your property, because if you have tenants moving in and out of your property over the years, then you want to make sure that the renovations that you do can last you for a long time, because the last thing you want to do is constantly keep having to repair and maintain a property every time a tenant moves out. So one thing that I like to do is have minimal or no carpet at all in a property. A lot of my rentals actually have this thing called laminate planks on the flooring, which is something that looks kind of like hardwood, but it's not hardwood, and it's also waterproof, so it's durable. And unlike a carpet, I don't have to replace it every time a tenant moves out. So it's easy to clean, easy to maintain. It costs a little bit more in the beginning, but it saves you a lot of money in the long run because it's durable and it looks really nice. In the kitchen, one thing that I like to do is upgrade the appliances. I like to put in brand new stainless steel appliances, because people like appliances they're going to be using a lot, and stainless steel looks nice. And if you take care of your tenants and you make them feel at home, then they're going to take better care of your rental property, and they'll be more likely to stay there for longer. An easy way to understand the level of renovations that you need to do in your area is just by walking through other rentals in your neighborhood or in your city around your property. That way you can see what other real estate investors are using, because the last thing you want to do is put in super expensive granite countertops when people are not willing to pay for granite countertops in your area. So just walk through a few rentals and see what people are putting in and see what people are charging for rent. Remember, your goal is to make money, and so if you're doing renovations, you want to make sure you're getting a good return on the renovations that you're putting in the property. Now, once you you got the property renovated, it's finally time for you to rent it out and start making money. Now you can rent out the property yourself and you can show the property and do all that, or you can use a property management company or a real estate agent. I recommend using a property management company. That way this whole process is automated and passive. I'm going to talk about that in the next step. But if you do decide to rent the property out yourself, you got to understand what you got to look for when you're trying to find a tenant. Because when you find a tenant, the last thing you want to do is you find somebody who says, hey, can I move in tomorrow? And you tell them yes, and then you just move them in and have them sign a lease. Because typically what you see happen is somebody who wants to move in immediately is also the person you got to kick out very fast. You got to do your background checks on tenants. So you can look at their credit score, you can look at their criminal history, and you can look at their past rental history. Typically, I don't really care too much about someone's credit history because there are so many things that can negatively affect one's credit score. I want to look at now your income, how much money you're making, are you consistently making money, and what is your past rental history. So I will call, or I'll have a property management call your previous landlords and ask them how you were paying. Were you paying on time? Did they have issues with you? If you're paying on time and you don't have a great credit score, maybe you went through a divorce or something else, then it doesn't matter as much. I just want to see, are you making enough money to support this rent, and are you going to have issues paying this rent 6 months from now? If you use a real estate agent or a property management company to rent out your property, typically they're going to take 1 month's worth of rent as their commission for leasing out the property. This is a fee that they take in addition to their monthly fees. So just factor that in, because if you have an agent or a property management company do this and you're charging $1,000 a month, they're going to take the first month's rent, $1,000, for getting your property leased. If your goal is to be a real estate investor, a true real estate investor, then you shouldn't be spending all of your time managing your real estate. Your job and your time should be spent finding more real estate investments and finding more real estate deals. That's why I don't manage any of my properties. I have a property management company that does all the day-to-day work. They find my tenants, and I don't even know who my tenants are. All I see is a report every single month which shows which properties are paying what rent and what the rental income looks like and what the expenses are. A property management company's job is to make your real estate investment passive for you. So they're going to take a fee every single month, typically somewhere between 4 to 10% depending on how many properties you have, and then they're going to charge you 1 month's worth of rent to list out your property, which is why you want to have tenants in your property for as long as possible. That way you don't have to keep paying that listing fee. But this real estate property manager's job is to really make it easy on you, because after you find the property and you get it renovated, you just want to hand over the keys to the property management company and let them do their job, find the tenant, and make sure that you get paid. A good property management company is going to know how to screen a tenant. They're going to have contracts and deals with a lot of contractors. That way you can save money on your renovations, and they're going to pay all your bills. They're going to pay your property taxes. That way all you have to do every month is just read your reports and see how much money you're making and let them handle all the work. I think every new real estate investor kind of goes through this phase where they're thinking, okay, I'm going to make $1,000 a month from this property, but why do I want to pay this property manager $100 a month or 10% of the deal? I could keep the extra $100 a month in my pocket if I just manage it myself. Yeah, you could make the extra $100 a month if you manage the deal yourself, but now you got to spend the time managing the deal and making sure that all the bills are paid and making sure that your tenant is paying rent. If instead of worrying about making the extra $100 a month, you worry about how do you create a new rental property and make a new stream of income for $1,000 a month, then the $100 a month expense doesn't seem so bad. So I want you to think about growing the pot, not just worry about how you can stop saving these expenses, because you as an investor don't want to be caught up in the game of managing. You want to be caught up in the game of how do you find more investments and how do you create more real estate deals. You want to think bigger, not just smaller. Now, you got this property, you've been renting it out, it's cash flowing, it's making you money every single month, and now let's assume it comes time where you want to sell this property and you want to cash out, because let's assume that you bought this property for $100,000 and let's assume that now it's worth $1 million. So now you have all this equity built up on this property and you don't want to refinance out of this property. You just want to sell and you want to be done with it. The advantage of you being a real estate investor is there are certain loopholes that you can use, legal loopholes, to sell this property and not pay any taxes right now. So this loophole is called 1031. It's the 1031 exchange, and essentially what it says is if you sold this property today for $1 million, then you'd have to pay taxes on your profits, in this case $900,000. Instead of you paying taxes on $900,000, which would be a lot of money, what you can do is you can take all of this $1 million and you can take this $1 million and use it to go out and buy another another real estate investment property, a bigger property, and now you don't have to pay any taxes on your profits today. So you invested $100,000. This property is now worth $1 million. Now you go out and buy $1 million property and you don't have to pay any taxes on your profit. And now you got more income coming in because you're not having income on a $100,000 property. You're having income on $1 million property. And so you can have more cash flow, more passive income, and you don't have to pay any taxes on your profits. This is not something that you can do in the stock market. If you invested $100,000 in the stock market today and your investments go up to $1 million and you sold it and you use this $1 million to go and buy new stocks, that might be a good investment strategy, but you still have to pay taxes on your profits. So while you invested $1 million, you still have to pay taxes on your $900,000 worth of profits. So if you don't have the money in the bank, then you might have to sell some of your stocks. That way you can pay your tax bill. You don't have to do that in real estate because of this loophole 1031, which lets you flip real estate and now you can own bigger real estate without having to pay any taxes on your profits. Plus, there's no limit to how many times you can do this. Like if you bought this property for $100,000, it goes up to $1 million, and you sell it and you buy $1 million property, then you can take this $1 million property, sell it, and you can use your profits to go out and buy a $2 million property, and you can do that again and again and again. So there's no limit to how many times you can do 1031, which can allow you to compound your wealth, because I'm sure you've heard of compound interest, and you don't have to pay any taxes, which could eat away at your wealth if you keep doing 1031. If you do decide to do this, talk to a real estate attorney early, because there's a lot of kind of little rules and details you got to follow in order to do 1031 the right way, and you don't want to accidentally get caught with a surprise tax bill. So make sure you talk to an attorney, because if you want to do this, you want to make sure you do it right. If you enjoyed this video, here's a video on buying a home that I think you'll love, and while you're at it, join our free finance and business newsletter, and as always, keep hustling. Like 9 out of 10 millennials say that they want to be homeowners. But unlike what your cousin Bunty says, buying a home the right way isn't so simple. If it was, you wouldn't have so many home buyers regretting their decisions.